Hey there, Seb by the REALTOR here. In this video, I'm going to explore the impact of the Federal Reserve's recent interest rate cut. If you're wondering what the Fed rate cut means for the sale or purchase of a home here in the Bay Area, then you definitely want to watch this video. Well, I'm a little late to the party because it was last week on September 18th that the Federal Reserve dropped its interest rates a whole 0.5%. A lot of people had been thinking they would be more cautious and only drop it by 0.25%, but they went for the big drop of 0.5%. And I'm sure you read the news. It was front page news. A lot of bloggers were talking about it. There's been TikTok videos and Instagram reels and posts all over Facebook and Reddit. And of course, YouTube videos where everyone is opining what it will mean, especially for the housing market. And a lot of people are saying it is good news for the housing market because it is going to mean there is going to be a drop in mortgage rates. And if there is a drop in mortgage rates, it means that people will be able to pay more for a home. So a lot of people are thinking this is going to increase home prices. Well, that's not exactly how it works, and I want to explain it to you. Even though I am no economist or financial guru, I do have sort of an armchair expertise, I guess you would say, with this kind of thing. So let me spell it out for you as best I can. First of all, it is important to understand that the Federal Reserve's rate and mortgage rates do not move in lockstep whatsoever. And many bankers will tell you that the mortgage market had already priced in a Federal Reserve rate decrease into the current mortgage rates. And so when we look what happened when the Federal Reserve dropped its rate by 0.5%, did we see a 0.5% drop in mortgage rates? And the answer is no, we did not see a 0.5% drop in mortgage rates. We might have seen something around a 1/8% drop, or perhaps a 1/4% drop, but not a 0.5% drop. So why is that? And the reason is because the mortgage market had already been anticipating that the Federal Reserve would in fact be dropping their rates because they've been signaling for several weeks since we saw those weak employment numbers come out, I don't know when it was, 3-4 weeks ago, that the Federal Reserve would be open to dropping rates at its meeting in September. And in fact, they did do exactly that. So that had already been priced into mortgage rates. But I think the drop was bigger than most people were expecting. You know, the Federal Reserve has been pretty cautious around interest rates for years now in their effort to tame inflation. And so I think a lot of people had been expecting only a 1/4 point drop, but we got a 0.5 point drop, and we did see a little bit of a decrease in mortgage rates, but nothing really dramatic. Now, why is that? Well, a lot of that has to do with the fact that actually the Federal Reserve rate does not really drive mortgage rates. Mortgage rates are actually much more driven by bond yield rates. So what have bond yield rates been doing? Well, take a look at this right here. It shows the past 5 years of both Treasury yield rates and mortgage interest rates. As you can see, there's a pretty tight correlation between the two. So then the question is, why have bond rates increased so much over the past 5 years? And there are a number of factors behind that. The first factor is that there have been numerous inflation concerns. Bond rates have had to rise in order to address the market's concern with the value of their investments decreasing. So bonds have had to increase their rates in order to attract investors. The second reason is because there's been a big change in Federal Reserve policy. For years, the Fed had a policy called quantitative easing. That may sound familiar, where they were buying lots of these bonds, and that was driving the yield down. But now the Fed has a new policy called quantitative tightening, where they are buying far fewer bonds, and because of that, the bond yield has had to go up because there's a lot less demand for these bonds in the market. The third reason is that good old Uncle Sam has been running in the red. They've been borrowing a lot more money, especially since COVID came along, and that means issuing many, many more Treasury bonds. In order to attract investors with so many more bonds, they've had to raise the bond yield rate in order to get people to buy these bonds. That has pushed up the rates, and that has also kept mortgage rates going up for years. And the fourth reason, ironically, is that the economy has been doing much better than expected. If you recall, there have been many people saying that, oh, we're going to have a recession. The recession never really showed up. The economy has remained very buoyant, and investors have been expecting that there will be an increase in interest rates and an increase in inflation due to this heightened economic activity, and that has worked to push the bond yields up for several years now. But if you look at this chart, you can see for the past 6 months or so, bond yields have been dropping and mortgage rates have been dropping right along with it. Now, why are bond yields dropping? Well, they're dropping for the exact opposite of the reason that they were increasing before. So inflation is coming down, and because inflation is coming down, that is allowing the Treasury to offer lower yields on their bonds. The next reason is that the U.S. economy is not looking quite as strong as it was. There was that jobs report showing lower than expected job increases and an increase in the unemployment rate. So when this happens, investors are looking for a safe haven where they can put their money, and they want to be buying these Treasury bonds. And because there's more demand for the bonds, the yield has gone down, also allowing mortgage rates to go down as well. The third reason that bond yield rates have been dropping is that for some time now, the Federal Reserve has been signaling that they would not be doing any more rate increases and would be looking at rate decreases. Now the Fed has finally actually cut rates, but they've signaled they plan to continue cutting rates. And bond yields tend to go down when the Fed is not signaling interest rate rises. Wow, so that is a really long way to explain why mortgage rates are the way they are and how they're not really tied to what the Federal Reserve is doing with their interest rate. But nevertheless, I think that the Federal Reserve rate cut is in fact good news for the housing market. And the reason I think so is because it really gives people a sense of optimism, right? Consumer sentiment is very, very important. People do not want to make huge long-term financial decisions like buying or selling a house when they are fearful, when they are uncertain of the future. And if people have more confidence in the future of the economy, they're much more likely to want to buy a house or sell a house and buy some other house in a different place maybe. So ultimately, I think that this really is good news for the housing market, but I am not really certain that it means that we're going to see any big increase in home prices. I see this a lot on Facebook and Reddit where people are saying, well, of course, because rates are dropping, that means home prices are going to go up. That just ain't the case, because home prices are dictated by the law of supply and demand. So then there could be more demand for housing because mortgage rates are down, right? People are, wanting to get into the market and feel like they can pay for more of a house, and you think that would increase home prices. But what's going to happen, probably, is that there will be more supply coming onto the market to meet that demand. And so if you have increased supply and increased demand, what happens to prices? They kind of level out. So I'm not really seeing that we are going to see like a big increase in prices. Prices are up modestly over this time last year. I expect that home prices probably a year from now will be up modestly over where they are today. But I think if anybody is expecting to see like a huge boom in housing prices because the Fed has cut their rate or because the bond yield rate is down, I just don't think that's going to happen because of the law of supply and demand. Prices are where they are today because there's been a very tight clamp on inventory. Inventory has increased somewhat, and if inventory does increase some more to meet this heightened demand, I really don't see that big gigantic increase in home prices coming. All right, well, that is all I have for this video. I hope you did enjoy watching it and that you got something out of it. And if you did, I'm guessing, and this is just a guess, you might also enjoy some of these videos over here. These are some of the most popular videos here on my YouTube channel, so please do take a look. All right, that's all I have for this one. Thank you so very much for watching, and please stay tuned.